$6 billion. That's what OpenAI burns every year, and your tech employer's equity grant assumes that math keeps working forever. If you're a software engineer, product manager, or technical worker holding 30-50% of your net worth in company RSUs at an AI-heavy employer, you need to hear this before Q3 earnings close the window on early action. Here's the hidden risk. OpenAI's burn rate against slowing revenue growth signals that AI unit economics may not support current valuations. That gap could trigger a 20-30% equity repricing in the next 12-24 months, completely independent of whether you stay employed. A tech worker with $300,000 vested or vesting in RSUs could see a $60,000 to $90,000 loss if that repricing happens while those shares are still locked up. Most people don't feel the risk until the stock drops and the diversification window slams shut. By then, it's too late. Let me show you the numbers and the 3 metrics that predict which AI employers get hit first. Start with the wrong belief. You're probably thinking, my employer is growing fast, AI is the future. My RSUs will keep appreciating as long as I stay employed. That's the narrative you hear in all-hands meetings and investor updates, and it's comforting, but Q3 data tells a different story. OpenAI's annual burn rate is $6 billion. Their reported ARR, annual recurring revenue, is around $4 billion. Do the math, they're burning nearly 2x what they earn. That's not a scaling business hitting profitability inflection. That's infrastructure cost inflation outpacing revenue growth. Now, OpenAI is well-funded. They're not going bankrupt next quarter. But here's what happens next. When burn rate exceeds revenue growth for 18+ months, unit economics deteriorate, margins compress, CFOs cut capex, hiring freezes, bonus pools shrink, stock underperforms. This isn't unique to OpenAI. Microsoft's Q3 10Q shows AI capex jumped to 23% of total capital spending, up from 8% 3 years ago. Google's Gemini Ultra deployment costs exceeded revenue contribution by 4x in Q2. Meta is burning $20+ billion annually on AI infrastructure for products that haven't monetized yet. The industry-wide signal is clear. AI infrastructure costs are scaling faster than revenue. Here's the delta. Your RSUs are priced on an assumption. Exponential AI adoption plus sustained margin expansion plus years of profitable scaling ahead. That assumption is unraveling. Research on public tech company valuations shows that when AI capex exceeds 20% of revenue for 2 consecutive quarters, equity multiples compress 15-25% in the following 12 months, regardless of headline growth rates. Why? Because Wall Street reprices on cash flow, not on user counts or AI features shipped. For $200,000 earner with 5+ years of RSU vesting at a major tech company, that concentration looks like $300,000 invested or near vesting equity. A 20% repricing costs $60,000 in household wealth. A 30% haircut costs $90,000. Now add the timing risk. If you wait until earnings miss to diversify, you're selling after the drop, locking in losses instead of avoiding them. The 3 metrics to watch. Inside reports on OpenAI, Google, and Microsoft show CFOs and finance teams tracking 3 signals that predict margin pressure 6-12 months before it's announced. ****1. Burn rate momentum. ****, not just the absolute number, but the trajectory. OpenAI's burn accelerated 18% year-over-year, while revenue growth flatlined at 3%. That's the danger zone. ***2. CAC payback and LTV expansion. If your employer is adding enterprise customers, but each one costs more to acquire than the lifetime value they generate, that's a sign unit economics are breaking. Microsoft's Copilot adoption hit this wall in Q3. ***3. Capex as percent of revenue. Above 18-20% sustained, and you're in uncharted territory. Most tech companies run 8-12%. When you're above 20%, it signals either a transition year, after which capex normalizes, or chronic overinvestment, which leads to cuts. The market hates chronic overinvestment. Check your employer's latest 10Q against these 3. If 2 are flashing red, diversification isn't optional. It's math. What this means for your equity: you don't have to dump your entire RSU grant tomorrow, but you should have a sell-down plan that's ahead of the curve, not behind it. Most tech workers wait until their employer's stock drops 15% to start selling. By then, you're exiting into a down market. The early readers diversify during strength, when the stock is near highs and you can sell without anchoring to loss aversion. The late readers hold, watching 30% of their net worth evaporate, then finally diversify into a crash and lock in the losses. Your personal risk is concentration. Your opportunity is information asymmetry. The fact that you're watching this analysis and most of your peer group isn't. If the AI infrastructure economics deteriorate, and the data says they are, the repricing is coming. The question is whether you're ahead of it or behind it. For the full breakdown of how to audit your personal equity concentration and the exact framework insider teams use to predict margin compression, the deep version is in my book, The AI Layoff-Proof Career. Link in the description. Here's your action. Audit your own 10Q this week. Pull your employer's CAPEX as percent of revenue for the last 4 quarters. If it's above 18%, pull your latest RSU grant agreement and do the math on what a 20% haircut would mean for your household net worth. The early reader already knows. In AI, the early reader wins. If this framework changed how you're thinking about your equity, subscribe. Next video drops Tuesday, covering the 5 AI employers facing the highest repricing risk in 2025. Ring the bell so you don't miss it. What's your biggest concern about your own equity concentration? Drop it in the comments.